Welcome to Africa Business Weekly, where the pulse of the continent's economy meets expert analysis. I'm Akin Obakeye, and I'll be joined by my colleague Abi and Karabo as we track the outcome of Nigeria's Monetary Policy Committee decision, the Africa Business Forum in Addis Ababa and in South Africa, a shocking halt in the government's planned budget, unveiling after a fallout with other parties in the coalition government, arising from the proposed consumption tax increase. Well, quite a lot packed in this show today, but let's cross over to Johannesburg and get updates from Karabo.
Thank you, Akin. This week, South Africa's Finance Minister Enoch Godongwana was due to propose a shock consumption tax increase to help rein in government debts, but the move was rejected by other parties in the nation's coalition government and derailed the unveiling of the budget. So, where to now for the South African economy? For more on this, my colleague Nastasia Arendse spoke to Jürgen Ackman, who's a wealth manager at Consult by Momentum, and Dr. Roy Haverman, senior economist at the Bureau of Economic Research. Let's listen in.
The government of national unity is working. What we saw was that members of the government of national unity had not been, it appears, been properly consulted prior to the tabling of the budget. And gathering from a Business Day column this morning by Gayton McKenzie, one of the members, they felt that that they did not agree with the increase in VAT by 2 percentage points. Author John Steenhuisen said yesterday that he also didn't agree with it. And so to some extent it is the GNU, the smaller parties in the GNU, saying that they do want to be part of this very important process, which is the budget.
Jürgen, you also, utter similar sentiments here when it comes to what we're seeing by basically saying that this is essentially democracy at work. Are there any concerns here, even though we are seeing democracy at work? At the back of your mind, are there any concerns?
It's a good question, Nastasia, and I'll be honest with you, I'm not a political expert, but ultimately, I think if we look in previous years, we've kind of just had to toe the line. So in a democracy, it's good to see that there's many voices around the table. And I suppose we'll have to wait and see what that results in. But I believe that it'll be in the best interest of every South African. And I think that's what I'm looking forward to.
Dr. Haverman, a lot of the documents are now in the public domain that were meant to be released yesterday, with National Treasury saying obviously they won't be in the position to comment on any of those documents that are out right up until March the 12th. But given the fact that a new budget is needed, what happens now when it comes to the revenue side of things? Are there any options or levers that the minister has?
Well, I think you should first start actually with the expenditure side of the budget, which hasn't really seen much talk because obviously everybody's been focused on the tax increases. The Treasury added a net 173 billion in new money to the 2024 budget baseline, most of it going to education and health. One of the things is actually, interestingly enough, something in the Better Bill, which is extending childhood ECD to children. And then for increases in the social grants, and then finally for money for infrastructure. So rather than, I think, asking the question, how can you pay for this? The first question you should ask is, should the Treasury be adding 173 billion in spending requirements? Many people have highlighted the fact that a very expensive ECD program is maybe unaffordable at the moment, although there's lots of positive things for ECD. But obviously, one of the issues is a very large increase in social grants, substantially above inflation. Interesting enough, the increase in social grants above inflation is actually almost equivalent to the VAT increase that the Treasury penciled in. So rather than trying to find new ways of funding all these new expenditure items, I think one should actually look at the expenditure levels overall.
In more news driving the region, South Africa, along with the rest of the world, is experiencing shifts in U.S. foreign policy, which could bring about a new era in global and international relations. To discuss the implications for South Africa-U.S. trade relations, my colleague Godfrey Mutizwa spoke to Stavros Nicolaou, BRICS Business Council member, as well as Azar Jamin, Director and Chief Economist at Econometrics. Let's listen in.
We've got to recognize that the United States is one of our most important and biggest trading partners, and also one of our biggest investors in South Africa. Now, how have we assessed the risk here? I think there were always 4 buckets of risk. The first was cutting off donor funding. And I think we're seeing manifestations of that. It's not a very clear picture.
Yeah.
Secondly, we're seeing AGOA being placed at risk. Thirdly, are there additional tariffs and sanctions? Fourthly, what does this all do for investor confidence? So let me just focus on the second issue very quickly. And that is, what is the way forward with AGOA? Now, AGOA has been reauthorized to September this year, and it's a reauthorization that takes place via the Congress. It's not the purview of the administration or the presidency. It's the purview of Congress, and we know the Republicans enjoy a majority in Congress. So there's no doubt that AGOA could be at risk in that South Africa gets excluded from the next version of reauthorization. But I think there's a bigger picture here for me. The bigger picture is that if the administration wishes to place tariffs on South Africa on some or all of the exports to the US, that kind of makes AGOA a little irrelevant, because the one will supersede the other. So where am I going to with all of this, Godfrey? I think in any event, it was time for us to re-look at, as a country, AGOA, and perhaps what we should be focusing our attention to is how do we enter into a more meaningful bilateral trade and investment agreement with the United States. It's going to work for both parties. I think in many respects we do need each other, and there are symbiotic and complementary areas that we can work together on. So the order of the day for me should probably be, do we channel some of this negative sentiment that's coming through on AGOA? Do we channel it into a broader new trade relationship with the United States?
Absolutely. As I come in as well, and I want your take in terms of your overall understanding of what's going on and what we need to do about it. I like the point that Stavros is making around understanding that this is not just about us. This is the US, in essence, seeking to fund its growth from abroad.
Without a doubt, that is absolutely correct. The second point that I think one needs to make is that, proportionately speaking, South Africa's trade with the United States as a proportion of its total trade with other countries is relatively small compared with many other countries and emerging markets in particular. So therefore, even AGOA, at the end of the day, accounts for no more than about 3% of our total exports.
Right.
So I think people are completely overplaying the relevance of it on our overall economy. And this is actually manifested in the fact that, and few people fully think about it, the Rand has actually appreciated by nearly 3% since Donald Trump began issuing his tirade against South Africa over the weekend before last.
Well, that wraps up the business news driving the Southern African region for this week. It's back to you, Akin.
Thanks for the update there, Karabo. Abby, walk us through the buzzing gist from the eastern part of the continent.
From East Africa, this week it has been buzzing with a big host of industry developments, with the Africa Business Forum happening in Addis Ababa, Ethiopia, to new shifts in the credit access space in Kenya. Diving in, the Alliance for Africa Multilateral Development Institutions are rooting for a more harmonized approach towards deepening investments in the continent through value chain financing. CNBC Africa's Tabitha Modoni spoke to Shelter Afrique's managing director in Addis Ababa.
For us, it's really about controlling the narrative and controlling the source of capital and the funding of our development. So we have several institutions that are in different sectors. We have guarantee institutions, insurance institutions, institutions that are in trade and housing and urban development, infrastructure, just like ourselves. So it's been really great since we've been here, and now we are at the Africa Business Forum.
Indeed, that's quite a huge milestone for you, and congratulations on that. So when it comes to financing or the funding aspect, when it comes to Africa, there's quite a lot that comes into place here, and I am keen on some of the policies that are in place, because collaboration is key. It is one aspect, but policies, they regulate everything that we do. So maybe what are some of the policies that you have put in place, and also maybe how best are you going to approach them?
Look, we cannot do good business without the enabling environment. So we definitely need to make sure that we collaborate with the governments to put the right policies, the right regulatory framework to encourage private sector investments and international investments in our countries. Look, just to take an example, as in Shelter Africa Development Bank, we focus on financing affordable housing and urban infrastructure. And today you have a deficit of 53 million housing units. And with that deficit, you need at least $1.3 trillion, right? So you're talking about $1 trillion. That's a lot of money. You take all multilateral development banks in Africa today, they are less than $100 billion. So you're talking about billions, and we need trillions. So clearly, we really need to capitalize and leverage more funding globally. And to do that, we need to have the proper regulatory environment, proper enabling environment. So we've been actually in touch with the government officials. We've been in touch with our partners. And as you know, the multilateral development banks are owned by government. So that's the advantage we also have to be able to have those discussions, right? Open conversations with our counterparts, our shareholders, which are the countries. In Africa Development Bank also is a shareholder of most of our institutions. And the idea for us is to really create a model, a framework that help countries improve the enabling environment. And this is exactly what we've done at Shelter Africa Development Bank. We have come up with a framework in the housing sector that we call viral. So how you make housing viral. But viral means vision, institutions, regulations, actors, and local initiatives. So we deploy that methodology to really do a diagnostic of the housing and urban infrastructure sector in Africa, in each of the countries, and we come up with a country strategy to see how we can improve the regulatory and enabling environment by putting in place strong institutions and strong regulations to help the country really address the challenges of a particular sector.
From Addis Ababa, we take you down to Nairobi, Kenya's capital, where the financial landscape is up for a shakeup, with a new credit-specific scoring model set to improve credit access to over 5 million borrowers who are not captured in the credit ecosystem. I had a candid chat with Maurice Minor. Let's listen in for more.
The credit market in Kenya is very robust. As we all know, Kenya is a leader in digital financial inclusion. And what that has done, and empowered largely by M-Pesa services, we have made a lot of strides in terms of having a lot of the adult population in Kenya included in the credit market. So that has been a good thing. However, we still have opportunities. We have opportunities with the level of participation in the credit market. When you look at the data that we sit with at the Bureau, we still have probably about 5 million Kenyans that are underserved, meaning their level of participation in the credit market is low. We also have on the other end about 10% of the adult population being formally unserved. So good strides, but opportunities and work to be done.
And Maurice, of course, this is a very timely initiative that you are pushing forward in terms of having a credit-specific scoring model. Perhaps walk me through how will this work and what impact will it create in the market?
I think what we've done and what we did yesterday, we did launch 2 solutions that have come out of clear market demand or market need. And this is, if you look at it from the perspective of the lender wants to have a much more comprehensive view of the consumer or the borrower so that they can make better and smarter decisions and be able to increase the approval rates that they do. And this stimulates credit access. On the other hand, if you look at the consumer is telling us they don't feel they have adequate access to credit, and that credit will change their lives. So on the back of that, we did launch 2 solutions, one of them in partnership with FICO, which is a global leader in credit scoring. We launched FICO Score that is working on Kenyan data. What that will do is just to arm our lenders with even more predictable tool for them to make decisions. We did also launch a solution that we have in our other markets, and we brought it to Kenya, which is credit vision variables. What that does, it enhances the view that the lender will have on a consumer, and they'll be able to make a decision that they would not have made before they got these tools. What credit vision variables gives lenders an ability to have up to 144 or 145 variables or data points regarding an individual. And this can be trended over up to 24 months. So great news there that just enables the lending ecosystem to even perform better moving forward.
So are you simply suggesting that with this such of innovation, we are likely to see the demand for credit rising? And perhaps what size of tickets are we looking at? Because when you look at the number of mobile transactions currently, we are standing at about 129 trillion shillings in the country, but we're not seeing an equivalent response when it comes to people taking credit that is of long-term nature.
I think you are spot on. What you may call mobile, digital, or micro loans are big in this country. 95% of the borrowers that we have in this country have one form of micro loan, or call it mobile or digital loans, or another. So that's big. Now, the solutions we have brought cut across all these lending products, from the small products all the way to the bigger products. So call it a mortgage, a personal loans, a credit loan, and even a digital loan, because you have to take the whole base together. And that then enables the credit ecosystem to leverage on these tools across the customer journey, when they are acquiring customers, when they are managing the customers, but also more importantly, it allows them to be able to make more prudent decisions at acquisition and opening door for more people in the population to get into the credit market. How do we see the impact? The impact at the end of the day is, how does it accelerate credit inclusion? How does it bring the 10% of the population that are not in the credit ecosystem into the ecosystem? How does it improve the 5 million Kenyans that are underserved into higher level of credit participation? And ultimately, the impact to the economy is obvious in terms of positivity.
Well, that wraps up our weekly update of news topping the East African region.
A candid conversation there with Maurice. Many thanks, Abby. Just like Ghana, Nigeria has left its policy rate unchanged at 27.5%. And analysts believe the Monetary Policy Committee of the Central Bank of Nigeria is concise in its policy direction, signaling a continued focus on price stability and economic sustainability. They expect a gradual rate cut from the next meeting in May. Take a listen.
No surprises, no stories. Remains resolute, as expected, hold, and let's watch and see. And he used the word gradual 4 times. Gradual about inflation. Right? So, what you see is what you get.
Could be, what were the key highlights for you?
2 key highlights. The central bank governor said, there's a statement he made, or a phrase he used.
Right.
He said the road of travel. And from what we've seen, just like Bismarck has said, no surprises. And I think if you're a foreign investor in Nigeria, you'll be very happy with what you heard today. The road of travel is clear. Not only is it clear, it's been clear for a while. The investors don't like surprises. They like to be able to plan ahead. They like to be able to make calculations, and to project where will I be in a year's time.
Right.
And with no surprises here, it tells us, and then from some hints that the governor gave, that we might be looking to cut rates at the next meeting, which is in May. So it's very deliberate. It's very well thought through. I would use strong, policy-driven, and methodical. Those are the words I would use in how our central bank governor has mapped out what he wants to do, how he wants to get it done, and how he's going to drive the reforms. And we're seeing the fruit of that. And the second thing I would say is maybe the one set of people who'll be slightly disappointed are borrowers. And then, and I think one of the questions he took addresses that in terms of, okay, so these rates are still a bit high, and that's in terms of lending rates, when will it get to our turn? And I think that was where he hinted that in future MPC meetings, we'll be looking at making those cuts.
All right.
So those are my two key
thank you
takeaways.
for that. Gregory, talk to us about your two key highlights from the governor's comments.
Yes, thank you. Well, I have to agree with my fellow panelists. How many times did the governor use the expression orthodox monetary policy? I know, too many to count. But the message was quite clear, and there were quite a lot of digs at the former regime in the governor's office, a lot of digs, in fact. But what he's saying is that the orthodox monetary policy will pursue it, we won't flinch, and we'll make ourselves more attractive for foreign portfolio investors. I think that was a point that came up quite strongly. Another one also, which I think it wasn't said, but unspoken contrast with the former regime, the relations between the central bank deposit money banks are improved. I mean, I think it's quite clear. And I don't think it's an exaggeration to say that under the previous regime, a lot of senior bank deposit money bank employees, whatever, may have felt that the central bank was just looking to pile on more and more fees on the banks. So much better relations there, contact with the chief compliance officers. So steady as she goes, we wait until May. And external sector also, lots of sort of positives that came out before his address, like the PMS price trend, the narrowing gap with Bureau de Change rate. Reserves are still robust. Okay, they come off the last 6 weeks, but there's still almost 10 months cover. So no great surprises, as my colleagues are saying. And we wait until 19th and 20th of May, when, all being well, we might get some monetary easing.
And in other developments, Microsoft has announced a $1 million investment to provide artificial intelligence skills for 1 million Nigerians. Now, the investment is targeted at supporting Nigeria's national AI strategy and create a future-ready workforce. Lillian Bernard, president of Microsoft Africa, shares her thoughts on the transformative power of AI in Nigeria's growth.
We literally flesh out the possibilities of this technology and what we can do with it, in the continent and, of course, across the world. Now, Microsoft is hosting this flagship event in 60 countries across the world. We're hosting it in Africa as well. And it was an absolutely exciting day. So what we did was that we actually showcased yesterday why Africa need to urgently adopt this technology to ensure that we accelerate our own advancement. But also, more importantly, how do we prepare ourselves through the training that we are providing, through the new possibility that will result as a result of artificial intelligence. So it was a great turnout from our customers, from our partners, where we really came together to talk about the possibilities and what we can do with this technology on the continent,
right,
and in Nigeria.
Right. Now, I wanted to also look at the business side of things, because you also highlighted that it's not just for upskilling youths, women, senior business executives.
Correct.
Business organizations themselves cannot afford to ignore AI and how it's rapidly changing. Why is this significant for them too?
So we always make the case for change, and this is what I said yesterday on stage, and I say to leaders, when we talk about artificial intelligence, you always have to contextualize it in the context of economic opportunity. A recent study came out and said that if Africa captures 10% of the global AI opportunity, it could increase our GDP by $1.5 trillion. For Nigeria specifically, it's $15 billion. And the moment you start attaching numbers to the AI opportunity, it becomes significant. I also said to business leaders yesterday that should you invest in AI, $1, for every $1, there's a $3.5 return. It makes sense. There's an opportunity for you to increase productivity, to re-engineer your business processes, to literally bend the curve on innovation. No organization should get left behind.
Right.
And as you think about your own growth, and if you think about exponential growth, your AI strategy is going to have to be at the center of it all.
Interesting. Now, let's go back to, upskilling. Microsoft, in the last couple of years, I believe since 2021 especially, we've had about 4 million Nigerian youths access your platforms, and you've been doing this in partnership with the Nigerian government, which also has a draft national AI strategy. For that AI strategy, let's start there. What will be key to the success of that AI strategy? Obviously the Nigerian government has partners such as Microsoft, which is good to help, also guide in terms of how to lay the framework and all of that. But what will be key to the success of such a strategy?
So for me, and this is the conversations that we're having with the government in Nigeria and actually governments across the continent, it's about an AI policy that gives you the flexibility to accelerate the implementation of this technology. And you will see that when we talk to government, we always talk about, we need to have a multi-tiered approach to AI, because you need to think about regulation, and it's important that we always do this with ethical foresight and think about our context. So that is key, and we need to make sure we unpack that. I think the second part of it is what we announced yesterday, which was specifically the AI skilling initiative for Nigeria. And this is focusing on AI skills plus cybersecurity skills. And you rightly said, 2021 we said 4 million, but now we talk about AI skills, because if we are going to capture the opportunity, it is about how do we ready ourselves for these new jobs that's about to come. And actually the data shows that by 2050, every fourth person in the world will be African. Africa's young, Nigeria is young. Those jobs will be taken up by young people, but it's about making sure that we skill them now to be ready for those jobs.
But that's all we can take on this week's episode of Africa Business Weekly. Special thanks to my colleagues Karabo Mashaba and Abi Agina. I'm Akin Obakeye. Enjoy your weekend.